Everyone, I want you to please be safe. It looks like I've gotten to the point where I have impersonators now that are reaching out, pretending to be me, and people are falling for it. I will never ask you to send me money for a meeting or anything like that. If you want to ensure that it's really me before you do anything or communicate with whoever's reaching out to you, please send an email to this email that I have on the screen and verify that we actually reached out to you. Please do not send money. It's not me. And I just hate that this is happening and that people are falling for these scams. Please stay safe, everybody. Hello, everyone. Welcome to the Trading with Ashley show. I hope you're doing okay out there. You're hanging in there. I know these markets are crazy, but it does look like that they have stabilized a bit, at least for today. Now, this is a volatile week. We do have the Wednesday FOMC decision, and so we are waiting to see. And if you are trying to trade this week, you may want to consider doing a few things to adjust your trading style because that's an unknown event that could have an impact on the market. So I'm going to go over a few of your favorite plays and maybe how you want to adjust how you're going to trade them right now with so much uncertainty. And I think this will give you some confidence, plus it will allow you to make some trades and generate some income safely as we wait for the market to pick its direction. I know a lot of you listen to and respect Tom Lee's perspective, so let's listen to what he has to say about the state of the markets, and then I'll come right back.
One of your next guests says the markets will find their footing before April 2nd, when the reciprocal tariffs, at least for now, are set to take effect. Joining us now for more is Tom Lee. He is the head of research and founder of FundStrat, also a CNBC contributor. Also joining us, Nancy Tangler, Laffer Tangler Investments CIO and CEO. Tom, listen, I understand it's a different White House. Every day we get a market-moving headline. A lot of people, I think, honestly, I'm just going to say it, they don't want to be neutral. They don't want to be data-driven. They want to be angry. I get that. But history says that markets will recover, right?
Yes, they've recovered every time. One thing we have to keep in mind is when markets fall this quickly from a 52-week high. I mean, just remember, less than a month ago, we were at all-time highs. That is a market pricing in a crisis. I'd say almost 50% pricing in a recession. And we're assuming there's no Fed put. Now, the Fed is in a position to cut rates. That really should mitigate the downside. And I do think two other things that investors have to keep in mind, because many people just want to get out until April 2nd, is number one, I do think there's a very high probability that a tariff solution happens before the next 3 weeks happens. And it's simple to see because China, Europe, Canada, Mexico, since April 18th, all of those countries have outperformed the US. I don't think that markets are that blind to say if Canada and Mexico are about to have a recession, they should outperform the US. And I think the second thing people should keep in mind is that when you have a global crisis brewing, and we highlighted like the 1962 Cuban Missile Crisis, that was a 12-day crisis, but the markets bottomed 7 days into the crisis. 5 days before that crisis ended, the market was already recovered 2/3 of the losses.
Now, as all of you are aware, the market is forward-looking. So one thing he said really resonated with me, and that is that the negative news has more than likely been priced in. And I do want you to realize that even if we do have a deeper pullback, I know we hit the 10% mark and that's considered a correction. If we pull deeper to 15 or 20% and we go into full crash mode, still the plays you're making today, a year from now, should be in a really good spot. And so even though we may not be able to time the bottom or get the very bottom, completely staying out of the market could be your costliest mistake if you are a trader. So what I thought we would do is let's go look at a handful of popular stocks that I know a lot of you trade. And the reason I know you like to trade them is my community likes to trade them. And I thought we would look at some potential plays that you could push further out. Now, when you're selling options, you're actually compensated for going further out in time. And the IB is more elevated now. So you could take on some plays that could push out maybe towards the fall. And as soon as everything picks back up, let's say we do have a rebound in April, you could take all of these positions and buy them back. Then that will release your cash for additional plays. But let's say the worst case scenario happens and we do go into a deeper correction. Doing these plays this far out should insulate you somewhat against early assignment, and that could be to your benefit. So it's just taking the tools at our disposal, in this case, selling puts, since most of our favorite stocks are down anyway, and using that to our advantage to get more premium and at least be able to generate some income in these uncertain times. Let's take a look at how the day ended on the overall indexes first. And to keep this as simple as possible, I just have the Bollinger Band populated. We're on a 3-month chart, and I have the 200-day moving average along with the RSI. So if you look at the SPY, the other day I had made a video where I had been purchasing some leaps all the way till 2027 to take advantage of the SPY being under its 200-day moving average along with the QQQ. And as you can see, we are starting to try to recover. If we reclaim that 200-day moving average and we close a candle above it in the coming days, and who knows, it could be Wednesday if the market takes a sigh of relief after the FOMC meeting, then we would have felt like that we caught the local bottom on the SPY. So I'm waiting to see how that performs, but I have went ahead and established my position in my longer term leaps, and a lot of my students have as well, because we know even if the market pulls back more, if we are going out to December of 2027, we feel like we still got a really good deal. So we're happy about that. Let's take a look at the QQQ. The QQQ is in a similar situation. We had slipped below the 200. We're still below the 200, but we are trying hard to regain it and fight back. So we'll see how that works in the coming days. Usually we should have a pretty good sense for it after the end of the day on Wednesday, and of course going into the weekend on Friday. Now, Tesla is an interesting one because it has struggled quite a bit in the last month. And we all know all the dynamics going on with Elon and how that affects it. And Tesla continues to be evaluated not for its future businesses of autonomous robots and full self-driving capability, but it is being evaluated based on car sales. So the fact that it continues to be suppressed actually is a buying opportunity for those of you that are interested in this stock longer term. So I'm going to show you a play we actually took today in my Discord community. And I like doing this on longer term plays on a stock that's really beat up because it can be safer if you're going further out with the intention of cashing it in early and releasing those funds. And this is a way, if you still want to trade, you can get in the game and make your trades a little bit safer. So let me show you what I'm talking about. Here's the play that I did. I went ahead and did a put credit spread. Now, this will be a 27% return on capital, and it's going much further out, so it leaves me time to watch the trade and adjust accordingly. But basically, what I did was I sold the $150 put, and I received for that $12.70. And then I bought to open the $130 put. So this is a $20 wide spread, and that one filled at $8.42. So those two things combined allowed me to get a credit of $4.28 a share, so it was $428. And this is something that I like to do when a stock is really beaten up quite a bit, because the fact is, more than likely, we will have buyers step in if Tesla dips that far below $200. So I felt like this was a good one. And if not, then we can break apart the trade like I did last night when I showed you that video and take advantage of being able to profit on the purchased put side and then roll down and out the sold put side. Let's take a look at Amazon. Amazon continues to struggle. It is below the 200-day moving average, but it's starting to trade sideways, and it's 34 on the RSI, so we know it is in an oversold situation. If you wanted to take a play on Amazon, I'm going to show you one that's going to push it further out. But as it continues to rise, let's say we have a rally in April, as some expect that we might have, you'll be able to buy this back in short order and be able to keep the difference of what you sold it for versus what you buy it back for. So if you're looking at this, the bottom of the band is 186. So that's a good place to anchor our trade. Now for this Amazon trade, I'm going to go further out, and I like trades where I know I can get a clean $1,000. So let's look right here. We saw the bottom of the band. Now it could go lower, but hopefully buyers step in because it's a quality company. So I like this 185 right here. And for this trade, I could get $10.15 a share. So that will be over $1,000 for agreeing to put up the money to purchase Amazon at 185. Well, we already saw that that's a fair price to purchase Amazon. Could you get it lower? Well, maybe, but you are being compensated $10 a share. So if you were early assigned in this scenario, you would still get the benefit of this, making it closer to about 175 a share. So if you were going to execute this trade, you would do a sell and do sell put at the 185 level, and you would receive $1,000. And as far as when to buy it back, if we do have more of a rally in April, then you could more than likely go ahead and buy this back at 50%, and then your money would not be tied up until August, obviously. Maybe you buy it back when this whittles down to $5, so you keep 500 of it, and that would be a really good trade in a short amount of time. For those with smaller accounts, you might be interested in something like Robinhood. Now, Robinhood had enjoyed quite the run, and then it pulled back with everything else, but it has started to find its footing. If you look right here, the 200-day moving average is 31, and today we had a bit of a rally, 7% up, trading closer to 42. So let's see what tomorrow brings, but if you go further out and do a trade that is around the $30 mark, it should be pretty safe for you at this point with all that Robinhood has going for it. So let's go try to find a trade that fits the bill. If we go out to June looking at a potential trade, let's look right here at that $30 strike price. We could get $161 if we sold this put. And again, you could wait it out till June, or if it starts taking off and we get a little bit closer to this date and we're nowhere near 30, you could just go ahead and cash it in for what it is at that point in time. And it does look like there is a lot of open interest. There's 4,000 open interest at this strike price. And again, for those with smaller accounts, let's look at SoFi. I've been trading SoFi quite a bit with my new trader network. That is my smaller Discord for smaller accounts where they can learn how to trade. And we have been enjoying the premiums we're getting from this particular stock. If you look at SoFi, you want to focus right here at that 200-day. It's right there, almost at $11. So any trade you take at the $11 mark should do pretty well for SoFi if you do it here soon, because we're close enough to it where you could take a local trade that expires within the next couple of weeks and do pretty well, or you could push further out if you want as well. Let's look at this $11 strike. If you were to take this trade, you would need to put up $1,100 to buy SoFi at $11 a share. But for doing that, you would receive 12 cents a share. So $12 may not sound like a lot, but if you analyze this return, you're well over 30%, which is a really good trade. So you could stick with this strike price and an expiration date that expires in about a week, or you could even go further out. Let's see what you could get if you go a little bit further out. If you push it till May, so May 16th is our expiration date, then look what happens. You get $78 for this trade. That's a really good return. Now, your money is tied up for a couple more months, but if SoFi takes off and you see it start to rise, you could go ahead and cash this in maybe when it whittles down to about 25 cents a share. Now, just keep in mind, if you do take that trade, earnings has not been announced yet, but it is in that time frame. So you'd have to consider that. The reason you're getting more premium is because you're taking risk trading over earnings. Enjoyed spending some time with you today. I hope that gives you a few trading ideas. Remember, if you're with me and trading with Ashley, there's no trader left behind. Now, for those of you that like trading the SPY and QQQ and you're interested in establishing your positions now while the market has pulled back, I've got the perfect video for you. You can watch that video right here.